Okay, so I guess we'll go ahead and start. So again, hey everyone, thanks for joining us on the webinar today. I understand it's like a Friday evening, but you guys still took the time to come and listen to us. That's a good thing. So I just want to welcome you guys to our Expert Australian Property Investment and Tax Strategies Seminar, brought to you by Odin in partnership with Telrock Capital. So I'm just going to start off with sharing a bit more about Odin. So Odin, we're the number one mortgage and tax specialist for Australian expats and overseas residents all around the world. Our focus is actually trying to get you guys the best mortgage deal and help you with the best tax advisors. We also have Telrock Capital with us. So Telrock is one of the largest expat-focused financial planning firms in Singapore, serving both the expatriates and the locals. So I'm going to go ahead and introduce our panelists. We have today with us Stephen Lee, who's the Director of Mortgage Services at Odin. Stephen has more than a decade of experience in Australia's banking and mortgage sector. We have Pao, who's our director of tax. Pao brings more than 10 years of expertise in helping expats, people like you, and investors with Australian tax, covering everything from strategic tax planning to preparing tax returns. And we're also happy to have Ian Black today with us. So Ian brings more than 30 years of experience in financial planning. He is actually very highly regarded with deep knowledge of Australian tax and superannuation regulations. So without further ado, I'm just going to pass the time with our first speaker, who's Stephen.
Yeah, thanks, Alvin, and good evening, everyone who's in Asia Pacific, and good morning to you, those who are based in the States or Europe. So yeah, and Alvin, thanks for the introduction, and it's such a pleasure for us to partner with Rock Capital to share some insights in what's happening in the property market, and then share tips and knowledge on planning your investment as well as tax implications. So I have the privilege to go first. So I'll just start with sharing my screen so everyone can see my screen now. Great. Yeah, so before we kick on, just wanted to manage everyone's expectation that the information that we're conveying throughout the webinar tonight, they are general. So we're not taking your personal circumstances into account. So the information today does not constitute any personal financial or tax advice. If you would like to understand how these information they will be sharing today would apply to you, it is the best thing to do to chat with specialists like us here tonight. So on that note, let's get started. So just to add to what Alvin just mentioned about Odin Mortgage and Tax. So our vision is to help our Australian expats and overseas investors to buy and own a property in Australia through our mortgage and tax offerings. So far, we have served our clients around 50 plus countries in the world, and we have 20 plus lenders in Australia and also some Asian banks on our panel so that we can offer a broad range of finance solutions. And to date, we had a pleasure of engaging with 20,000 plus Australian expats, where of those 20,000, just over 1,000 clients have gone through their property journey with Odin Mortgage and Tax. So I'll be talking to some insights to the property market and focus on mortgage before we pass on to Power and Ian on the webinar. So at Odin, we help on the mortgage side, we help our clients on two things. So one is home buying and refinance. So whether you're buying your first home in Australia or looking to grow your property investment portfolio in Australia, our specialty is to help you um, find the right properties, and also through our mortgage offerings with the settlement service, that we make it as effortless as possible for you to kick on your property journey with us. And if you are already an existing property owner in Australia, that's fine. That we also help our clients to refinance their existing home loan by assessing the best available home loan products in the market so that we can help you save your home loan expenses with better options that is available in your market and also help you with an opportunity to assist with accessing equity in your existing property for your next investment journey. So we specialize in our foreign income policy and the niche sort of areas of whether they're Australian lenders or Singaporean banks or Hong Kong banks. That's where our specialty is, and we've got our end-to-end team in the background helping you through to prepare the application, support you with finding the property, as well as to make sure that your home loan is approved and funded. Therefore, your property is settled on time, and more importantly, our service lasts throughout the life cycle of property. So we've got our concierge team helping you monitor and maintain your home loan products to make sure that you're on the best available product in the market until you decide to close down the loan or sell your property and close the mortgage. So in terms of what's happening in the market, so the screen that you're seeing at the moment, it's just a snapshot of the market as of late May. So in Australia, the property market, the residential property market is very resilient and sticky to the nation. So more than 55% of total household wealth is now attached to the residential property in Australia, which is now worth at $11.3 trillion AUD. And despite of the economic downturn over the last 12 to 18 months, the property market in Australia has remained very resilient. So as you can see on the chart, nationwide, that the market has still delivered 3.4% growth, while Sydney and Melbourne are going through some corrections. The western states like Perth and Adelaide and Brisbane have carried the market growth, as you can see on the slide, that especially Perth and Adelaide have still delivered double-digit growth over the last 12 months. So the market is very resilient, and we're actually expecting more and more um, expat buyers as well as foreign investors to enter the market alongside the local buyers. And that's also stimulated by the recent changes to the credit landscape. So, some of you may have heard of that, the Reserve Bank of Australia, the central bank in Australia, have recently announced two rate cuts this year. So, in the last a few years, the interest rate have been climbing towards 4.35%. And for the first time in the last 4 years, the government has finally started dropping interest rate from February this year, and then another one in May. Although earlier at the board meeting, the government has kept the interest rate, cash rate at 3.85%. The commentary from the RBA indicating that they need to see more data on spending. It indicates that it's a matter of time when the next rate cut will be coming. So what that means is that the cost of borrowing is going down. So as the government has started dropping interest rates, Australian lenders have been scrambling to compete in the market to attract more and more buyers. So we are now seeing the interest rate in Australia started dropping from mid 6%, so 6.3, 6.5%, down to as low as 5.8% to 6% on a variable rate for investment home loan. So what that means is that the borrowing cost is coming down, but also it's an opportunity for you to exercise your bargaining power with Australian lenders. So if you already have a mortgage in Australia, now is the perfect time for you to reassess the interest rate that you're on and make sure that you access the best available rate in the market. And when it comes to buying a property, I wanted to outline just some numbers that people need to be aware of. So, when buying a property, your purchase cost is determined by two things. One is your deposit, and the other part is the loan. So, typically, most lenders in Australia would offer lending up to 80% of the purchase value, subject to credit assessment and your borrowing capacity. What that means is that you need to come up with 20% of the purchase value plus the stamp duty and the legal cost as a fee. So if you're an Australian citizen or Australian permanent resident who are living and working outside Australia, one of the myths that I'd like to bust today is that you're not subject to any foreigner surcharges or additional fee such as FIRB fee, that you're still subject to nominal stamp duty and the government charges as if you're buying a property while you're living in Australia. However, if you do not hold an Australian residency or visa, that you may be subject to additional surcharges such as stamp duty or FIRB fee, which it could be as high as additional 7 to 9% of the purchase value. Now, when it comes to your loan, so it is driven by your borrowing capacity that is based on your income, expenses, and assets and liabilities. So Australian lenders they look at a cash-based lending assessment. So what that means is that they'll look at your household or eligible income and apply their own credit policies to determine how much eligible income that you would have access to, and then compare that against your expenses, such as your general living expenses, credit cards, mortgages, or any other housing expenses. So that's where our team comes in with a specialty to help you understand what your borrowing capacity might be through a single conversation. So, and this is something for expats or borrowers who are residing in Singapore, given both Odin and Tarok have presence in Singapore. So it's a snapshot of a lender comparison. So as I mentioned that we have 20 plus lenders on our panel between Australian lenders and Singaporean banks. And we typically categorize our panel lenders into three groups. So Australian banks, the non-bank lenders in Australia, and lastly, Singaporean banks. So Australian banks, so-called Big Four banks or regional banks such as ANZ or Commonwealth Bank that you may have heard of, that they typically lend to Australian citizens or New Zealand citizens who are living and working abroad or outside Australia, and by exceptions that sometimes that foreigners could access these banks. And I guess the advantage of Australian banks are typically the competitive interest rate with low upfront or ongoing fees, and also some flexibility that's provided to help you maintain your home loan, such as an offset account or flexible repayments. However, the consideration is that a lot of Australian banks have their own limited appetite on the foreign income. So some banks typically apply pretty harsh restrictions that could be anywhere between 20 to 40% haircut to your gross income. However, if your borrowing capacity is sufficient, then you may be able to access up to 80%. And the non-bank lenders, so-called non-traditional lenders, they often offer higher interest rates and fees. However, what they come up with is more flexible credit policies than Australian banks. So typically, non-bank lenders apply as minimal haircuts as possible to eligible income. So what that means is that for the same amount of household income, that you're likely to be able to access more borrowing at the cost of high interest rates or upfront fee. And also, most non-bank lenders typically offer anywhere between 80 to 90% of the purchase value, which would then allow you to enter the Australian property market with a small contribution or deposit. Then lastly, some Singaporean banks do offer lending against Australian properties, and it varies by banks, but typically local residents in Singapore or some Australian residents will be able to access. So the interest rates are fairly competitive. So 6 months ago, I would have said Singaporean banks would have offered a lot more competitive interest rates. But now the as the interest rates in Australia have started coming down, now the rates are fairly competitive between Australian banks and Singaporean banks. And I guess the another flexibility is that most Singaporean banks do offer flexibility with the multi-currency between Australian dollars and Singaporean dollars. However, some catches are that often there are minimum lock-in period, whether it's 1 to 2 years, and also a limited flexibility on early repayments. And then lastly, around the policy, it is completely subject to TDSR in Singapore. So if you already have an asset and liability in Singapore, that access to mortgages to purchase an Australian property through your Singaporean bank could be limited. And also, often Singaporean banks limit maximum lending to 60 to 70%. So by all means, you can still access information about all of these lenders through a single conversation at our team at Odin. So for those who've got their phone, I've got the QR code up for you to book a meeting at the time that suits you. So lastly, before I pass on to Pao, that this is just a general home buying process in Australia, more for your knowledge. So typically, it could take anywhere between 3 to 6 months from the time when you start looking for property until you actually find the property and then settle on the property to own the property. So typically start with assessment. That's where we would help our clients to assess your borrowing options and loan structure, and also how much funds will be required to enter the market, and also help you set the boundaries of the maximum budget so that you know your areas or scope that you can play with as you start looking into the property market. And we also help our clients to arrange so-called pre-approval, which is in-principle approval issued by the bank based on your income and expenses. And that's where we'd help you go through all the document collections and have the application forms ready on your behalf. And once you find a property, then we'll help you get into the approval stage, typically unconditional approval or so-called formal approval. So that's where the bank would, lender would conduct the valuation on your property to make sure that the property itself is satisfactory according to the credit policy. And once that's done, that will help you prepare your settlements. So on the settlement, between approval and settlements, that will help you execute loan contracts, and will work with your conveyancer or solicitor to make sure that everything's in order for the settlement. And on the settlement date, it'll be your lender, solicitor, and the vendor will meet together, and we'll make payments to the vendor, and you'll have access to the key, or have the property handed over to you. And again, as I mentioned, that our service lasts throughout the life cycle of the property. So we have our concierge team helping you to make sure that your loan product is on top of the market through a regular review of your home loans against the market. And for any post-settlement inquiries, such as your account setup or repayment or interest rates, that's where we can help you access all this information rather than you yourself calling or inquiring to Australian lender through an international phone or a very lengthy email. So yeah, I'll pause there. So that's about Odin Mortgage side. I guess the last message is that we are in a very privileged position where more and more expats and foreign investor clients are taking up our service. And this month, we've actually seen so the number of clients who have come up with contract of sale, which means that they've secured finding property, have increased by 250% compared to last year. And that really tells the market's now really activated and more buyers are entering the market. So therefore, it's getting more competitive. So if your plan is to buy a property in Australia at some stage, I'll suggest now is the time for you to start looking and make sure that you have your ducks in a row, whether that's your loan approval or deposits or even your budget. So that's where we can help. So I'll pause there. Thanks so much. And I'll pass over to you to introduce Odin Tax.
All right, thank you, Stephen. And let me try to share my screen as well. So again, I look at a quick introduction about myself. My name is Pal. I look after the tax business here at Odin, with over a decade of experience helping Aussies and foreigner who live abroad to navigate the tax issues back in Australia, make sure you protect yourself from a non-resident perspective. So whatever you make, your hard-earned money overseas is not taxable in Australia, and also look after you from what you have back in Oz. So I'll quickly touch point on these three major topics today on tax residencies, how does it impact you, and when it comes to properties, what are the tax that we're looking at, and the net gearings, etc. and eventually the capital gains. When you exit the market, how does it work? Okay. So the way ATO or the government right now is still looking at someone's residency, look at these four major tests: the 183 days, the reside test, the domicile test, the Commonwealth superannuation. The first one's quite direct, looking at the number of days you spend in Australia. But to a certain extent, is that even though you spend less than 183 days, there might still be a chance that if you couldn't pass the others, you can still fall into the trap of being a tax resident in Australia, which means whatever income you make overseas is not taxable in Australia. And for people living in Asian regions, Hong Kong, Singapore, you obviously pay a lower tax compared to Australia, and that's why you want to protect yourself to be seen as a non-resident. You don't want to have your Singapore income to be taxed in Australia. The reside test will look at where do you live in general. What is your intent? Is your family with you? Are you having employment in the country they're living? Do you have a place? All of these to show that if not living in Australia anymore, where do you live in general? So we need to show them the intent that you want to live overseas for at least 3 years, for example, in a row, to establish that you're living abroad, no longer in Australia. And the domicile, which is the most difficult, because if you're holding Australian passport, PR, that becomes a problem, right? But it's not necessarily that because you're holding Australian, being Australian, holding a passport makes you a tax resident for tax purpose. We also look at domicile by choice. Where do you want to be living? And this can be by showing them you have a long-term fixed place overseas, which doesn't mean that you have to buy a property in Singapore, for example. You can be having a long-term lease that also helps to establish your domicile in other country. The last one, the Commonwealth superannuation test. This is for those people who are on assignment to be working overseas for the consulate, embassy, for example. They're still working on the Australian soil. They're working for the government under the superannuation, so they are automatically be seen as a tax resident for Australia. So, but this I say account only for maybe only a few percentage of expats living abroad. Most of the client that we come across is working for the private sector, for the private companies. So we then fall into the three major ones: the number of dates, where do you live, and the domicile. And when it comes to property, I always love to break it down into three stages. Stage of buying the property, what is the upfront cost, like stamp duty, FRB, conveyancer, buy agents, etc. And to once you settle, what is the running process? Okay, when you own the property, what are the income expenses that you need to look into and report to the tax office, and make sure they understand that you're a non-resident and you're potentially making a loss on the property. You can enjoy the negative gearing. And when it comes to selling the property, that's when the CGT will kick in. All right, so this is when we then look into what sort of capital gains you pay at the end when exiting. For cost of buying, these are the major ones that you would take into account: the stamp duty and the surcharge. So everyone pays the normal stamp duty, and the surcharge comes only for foreigner who want to buy a property in Australia. Right now, we're looking at around across literally all states, around 7 to 9% surcharge. So you need to be mindful of a year foreigner, which is you're not Australian passport holder, you're not a PR. And even for your PR, you might want to be careful. The only state which is in New South Wales. If you're PR living overseas and want to buy in New South Wales, you need to be mindful of this surcharge will also apply on you. The others are quite standard. The conveyancer, the solicitor will help you settle the property. The buy agent, if you're using someone to help you secure or source the best investment property. Some of the miscellaneous like patent report, building reports, mortgage fees, all of these are also deductible as well. And the last one, the FIRB, you need to be paying. If you're a foreigner, you need to be approved before you can actually buy a property in Australia. They need to look at, are you a natural person that you have the right and you can buy a property in Australia? So you need to be submit an application and get approval. And when it comes to settling after you settle the property, most of our client would be running the property as an investment property. They'll be collecting rent from the property, and these are the expenses they can claim to offset the rental income from the local council rates, water rates, land tax, the insurance, to any of the repairs, maintenance, the biggest expenses on the mortgage, and any of the body cop, if this is apartment, depreciations, and obviously the accounting fees also deductible. Only when you have factored in all these expenses and you're still making a profit, then you pay tax to the government from 30% from first dollar as a non-resident for tax purpose. If you're making a loss, then you can accumulate the losses going forward. So this is example for the negative gearings. Okay, imagine you've been making a 45,000 rental income from this property in New South Wales, and your total expenses amount to 60,000 per year, including everything you pay for in a yearly basis. This will bring you a $15,000 of losses, and in that way, you don't pay tax to the government. You're making a loss. And these losses can be used to offset the other taxable incomes if you're having employment income in Australia, for example, or from other source like selling another property, have capital gains, you can apply these losses to offset. If you have nothing to offset, these losses will just get carried forward to future indefinite until to the point that you start to have other incomes again. And this is another very common question when it comes to, should I be buying the property under my personal name or should I be using a trust? I heard trust is quite common in Australia. That brings into two considerations. One is the mortgage, the other one is the tax implications. As Stephen mentioned before, we need to find the right lender for someone living overseas and for these lenders to accept your foreign income, so which is already kind of hard. They are limited lender already, and it's going to be even harder when they consider using a trust structure for lending. So number one is, can you get finance using a trust structure? If you need finance, that's number one considerations. If you don't need finance, maybe trust will make sense for you. But most of our clients, they would like to leverage with the mortgage and enjoy the negative gearings, and that's why that becomes the number one hurdles. And the second one is, do you actually get the benefit of using a trust? People use a trust a lot because they are making profit under the trust, maybe from the rental properties. But then they want to distribute the income to different beneficiaries to enjoy paying lower tax to different persons. But for expats, the most common one we've seen is you having a mortgage, most likely making a loss on the property as well. There is nothing to be disputed. So you're making a loss. So there's nothing to be disputed. You kind of lose the meaning of using trust. And also, these losses will be trapped within the trust. You can't use it on your personal level if you want to offset your other income. So at the end of the day, I say most likely 90% of the clients ending up using their personal names for the purchase. And when it comes to capital gains, there are different rules for non-residents as well. We are only liable for the item that is considered as a taxable Australian property, which is most likely the Australian real estate properties. Okay, residential property, commercial property, these are taxable for CGT. And one funny thing is shares. If you buy Australian shares, these are not taxable Australian property. If you buy shares as non-resident and sell as a non-resident, you pay no capital gains tax. So just be mindful of on this one. We do have some clients who have this skill set. They are actually looking through the Australian shares market as well. But circling back to properties, another difference is that if you are non-resident of Australia for tax purpose, you do not enjoy the 50% capital gains discount since the rule change in May 2012. So you no longer enjoy the discount compared to people in Australia. They do have enjoyed the discount. So let's say if you make 100,000 profit, people in Australia can enjoy the discount. So they only pay tax on half of it. But for us, we pay from 30% of the 100,000 of profit. And the capital gains works in the way that your sales price minus the purchase cost, minus the expenses you pay on buying the property, and then minus the losses you have accumulated to look at the net number and to pay tax on it. And also be mindful of the main residence exemption rule change. If you have your main residence in Australia, you might want to consult whether you should sell now because you'll be losing the main residence exemptions. You're going to be paying a huge tax when selling your properties. You're actually, especially your home that you live in the past, as a non-resident for tax purpose. And another one is the now this withholding system, which is like a tax in advance. Okay, the ATO, the tax office, want to take some money from you when you're selling your property in Australia. They want to take a 15% of your sales price at any point at any sales price. You want selling for $1 million, they want to take 15% of that at the settlement to be treated as your potential capital gains you pay on the property. And the best you can do is to do a variation. If you can show them that, right, based on the calculation, the CGD calculation, you pay much less than 15%, then you can do a variation to reduce the withholding rates. And here, just running a quick example as a non-resident, full-time non-resident buying property in Australia. So assuming you buy a property in 2016 for $700,000 and you sold in 2024 for $1 million. All right, 8 years, you make 20,000 of profit on the property. And the expenses you put in, the stamp duty, the legal fee, agent fee, everything added up to be $90,000. And throughout the 8 years of period, you have been running the property at a loss, and you have accumulated 100,000 of losses. So the math works in the way that $1 million sales price minus your original purchase price is $700,000, less the cost of buying the property, you would have a capital gains of 210. Okay. So with this 210, you then minus the losses that you have accumulated throughout the 8 years of ownership. This will further reduce your taxable income to 110, and you only pay tax on this amount at 30%, which is $33,000 goes to the tax office. And that's another tips, which is you can utilize your Australian super to reduce these amounts. We can do a voluntary contribution super and to claim that as a deduction to offset the taxable income on your personal level. So by that way, you can save, instead of paying 30% to the government, you only pay a 50% tax when inside super for the amount that you want to claim as a deduction. So to wrap up, the takeaways is, consider mortgage if you, because of the existence of negative gearings, you might want to take advantage of that. But then you don't need to bring that much of money into the table to purchase the property. And at the same time, you can apply net gearing to offset the income, no pay tax to the government, and apply these losses in the future. And if you already have multiple properties, you might want to diversify your investment portfolio, not to put everything in the same states, which would increase your land tax payable, and also you want to be less exposed to one single market change. When New South Wales is suffering the last 2-3 years, you'll be happy if you have some other properties in Brisbane and Perth, which has been crazy in the last 2-3 years. So look into those to diversify your investments, and always focus on long-term creation on wealth, because you are not really making any money on the rents if you're having a mortgage. But this is why you want to focus on the growth of the properties, and this is where you truly make your money from after you pay off the mortgage, pay off the tax. This is where you gain most of the money out of it. Okay. So I'll stop from here for the tax part, and I'll probably pass on to Ian to talk about the finance, how being an Australian expat living overseas, how you should look after yourself from a finance planning perspective.
Thanks, Paul, for that. Now I'll see whether I demonstrate myself to be a Luddite or I can manage to share my screen properly. So let's give it a go. Share. So hopefully this is working. What I'm going to do is briefly chat to you about how you can minimize tax on your investments. So not your property. Odin have spoken about things that you can do there, and I'm sure these guys can help you with strategies in that respect. But for money you have invested, it's important that you make sure that the way you hold your investments is going to minimize tax once you're back in Australia. So what I'm going to go through a little bit about Tall Rock Capital, because you'll be wondering who we are. Then a quick refresh on how investments are taxed when you're in Australia as an Australian tax resident, and then what kind of strategies can we employ to minimize that tax when you're back in Australia. So a little bit about us. As was said at the beginning, we're one of the largest financial planning firms in Singapore. We work very closely with Australian expats. We provide advice on wealth management, retirement planning, including super, insurances, education fee planning, estate planning, and general tax efficient planning. We are multi-award winning, and also our clients are very kind to us and have given us a top rating on Trustpilot. So we must be doing something right. We're headquartered in Singapore, but we do work with Australian expats across the region, and our advice is tailored to your own specific needs. Anything that we do is going to be holistic. It's going to be backed by data, and it takes account of your short-term immediate needs, medium-term needs, and long-term goals. Whether you're looking to plan for now or when you go back to Australia, we can work with you as your full-time partner in terms of planning. If you have other advisors, such as Odin, we can work in conjunction with them to make sure that we have complementary strategies and put you in the best possible position. I guess we could summarize that by saying we completely focus on your long-term financial success. So, tax in Australia. Unwrapped investments, and by that I mean if you've got shares or that you hold through the bank or on a platform such as Macquarie, anything like that, then this is the type of investments that I'm talking about. So your dividends taxed at marginal income tax rates. Some investments in Australian companies will give you franking credits, which give you a little bit of a tax offset. Doesn't really reduce your tax, it just means you pay some of it through the system. Gains, you're taxed at your marginal income tax rate, so it goes on top of your income, and whatever tax rate that is, you pay at that rate. If you sell Fund A and buy Fund B, that's a switch, that is a disposable for capital gains tax purposes, so you will pay tax when you do that, on the assumption that you've made money in your investment, which is what we all want to do. And as with property, once you're Australian resident, you can have a 50% discount if you own an asset for more than a year. Now, it's not the overall portfolio, it's each individual constitution in your portfolio that matters. So if you don't hold a share for a year, then you don't get that discount. In the event that you pass away and you leave your investments to your loved ones, the beneficiaries will pay capital gains tax when they sell the assets that they've inherited, and that will be based on the price you paid for these assets in the first place. So estate tax is gone, but it's kind of still there. And don't forget, Medicare levy does apply to dividends and capital gains, so don't forget to add that on when you're doing your sums. So the whole point of the planning that we do with Australian expats is to look to create tax-free wealth over a 10-year period. And we also look to avoid the restrictions on access that, for example, super has. You have to wait for your preservation age to be able to access, but if you don't retire fully, you have to wait till you're 65 to access your super. So if you want to retire earlier, having a complementary strategy that will allow you to actually retire earlier can be very beneficial. So what we look is, we use what's called an offshore life plan. It is very beneficial. There's no tax on the gain or the dividends or the interest that's earned inside the plan. When you come to take money out, there's reduced or no tax on the money that you take out. Your beneficiaries don't pay any tax at all when they receive money. If you pass away and you leave this to them, it's much easier to deal with because you're not dealing with multiple banks, fund companies, shareholdings. You have a single source of truth for your money and a single way of dealing with your money. So reporting becomes very easy. It is something that you can take with you around the world. So if you're in Singapore today, then you move to Hong Kong and then to London. It can go with you and it's tax friendly all the way. And the other important thing to consider is that if you own an asset and you pass away, that you need probate for your beneficiaries to be able to access that money. With an offshore life plan, that isn't the case. They can have access to that money straight away. So there's a lot of things going for these plans. So what about tax freedom in 10 years? What's that all about? Well, you invest in an offshore life plan. You can access funds, ETFs, stocks and shares, Australian stocks and shares, American stocks and shares, UK, you name it, you can have them, or cash deposits. All of those can be held inside the offshore life plan. There's no tax unless a withdrawal is made. And as an Australian resident, if you take money out in the first 8 years, then the gain that you make, and that's worked out with a formula, is taxed at your marginal rate. In year 9, so 8 years and a day onwards, you get a 1/3 discount. In year 10, you get a 2/3 discount. But from 10 years and a day after you started this plan, it's not assessable income. There is no tax due, no income tax, no capital gains tax, nothing. So it becomes extremely attractive very, very quickly. So in terms of investment limits, well, we all know that with super, there are limits to how much you can put in tax relief money, how much you can put in your non-concessional amounts. That doesn't apply to an offshore life plan. There is no cap on the amount you can invest. There is an anti-avoidance piece that says that if you put in more than 125% of what you put in last year in this year, then the 10-year clock restarts. Why do they do that? Because many years ago, what people were doing was putting in a small amount of money and 9.5 years in, putting in a very large amount of money and a couple of months later saying, oh, it's tax-free, which was not the intention. But we work with you to ensure that you don't breach that rule. So very, very flexible in terms of investment limits. Question we always hear from Australian expats is it legal? And the ATO have looked at this. They've issued many private and product rulings for this type of structure to confirm how it works. It is subject, for those of you who want to dig into the tax, to Section 26AH of the Income Taxes Act. That's been around since 1936, so it's not a new law. It's been around a very long time and applies to Australian insurance products as well as offshore insurance products. But as expats, you have access to the offshore insurance products which don't pay tax inside like the Australian ones would. So the kind of things that they say in the public, in the rulings, when you go back to Australia, then the gains and the dividends that are being accrued each year inside the policy, will they be included in assessable income? And the answer is no. And at the end of the 10-year period, they call the gain revisionary bonuses. And this is because back in 1936, insurance policies paid bonuses. So hence the name, but that's the gain. So will any revisionary bonuses paid on surrendering or otherwise coming to the end of the policy be included in assessable income at the end of the 10-year period? No. And there are hundreds of these assessments and rulings from the ATO. So we can share that with you if you want to see more detail, because clearly I'm a bit limited for time to go through things. So what does this mean in terms of what can it do for you? Well, let's just look at an example. An investment of 500,000 Aussie dollars, growing at 7% a year, invested for 15 years, and at the point that you cash out, you are a top rate taxpayer in Australia. So what does that do? Well, if you're on an investment platform such as Macquarie, for example, then the gain you realize is $879,516, which is the same as the offshore life wrapper. Where the difference comes is in the investment platform, you will give to the ATO $206,686. And with the offshore life platform, you will give them nothing. So the net proceeds after tax are almost $207,000 more with the offshore life wrapper. So it does have a significant impact on your net wealth and the outcome at the end of the day. So it's a great complement to the super, as I've mentioned. No tax within the plan. As we know, super does have tax within the plan. There's no preservation age. So if you want to start investing and then you want to retire at 55, you can. And there's no retirement restrictions before age 65. So if you want to part retire, you can do that too. And there's no transfer balance cap. With super, there's a transfer balance cap. Anything over 1.9 million gets taxed. Doesn't happen with the offshore life plan. Just about done. Just one more thing to say to you. If you invest in US shares or US ETFs and funds, as non-resident in Australia, you will be subject to US estate tax if you pass away, and that will be for up to 40% on everything over $60,000. If you hold those shares or the funds inside the offshore life plan, that doesn't apply. There will be no US estate tax if you pass away. That can be very significant, particularly for those who have been getting share options from US employers. So I guess to kind of sum up and get to the end of this, it's essential to take advice both on the side that Odin were talking about and on the side that I'm talking about, because it is very complex. If you get it right, you can be much better off than if you get it wrong. And without advice, there is more chance that you will get it wrong than get it right. So what's next from the point of view of the financial planning aspect? Well, if you've got an Australian super, which you probably have, review it. Come and talk to us. We have an Australian super audit that looks at the super. It works out what it's going to do for you at the end of the day. Also make sure that you are in the most cost-effective, best Australian super you can be in. Review your savings and investments. Make sure that how you're holding these investments is tax optimized for you. Another thought is review your life cover, because life cover that you have perhaps in your super or that you've taken out when you've been in Australia very often doesn't cover you when you leave Australia. And if you have simply taken a fixed amount of cover that was offered, it might not be the right amount. It might not be enough if something happens to you. So it's important to have a review on that aspect as well. So as a quick checklist, think about how are your investments and existing investments and how they're structured going to be treated for tax purposes when you get back to Australia. Do you need to restructure before you go back, or isn't there an issue there? Should you act now to get that 10-year clock going? And if the 10-year clock's going to benefit you, and for most people it does, the sooner you start, the sooner you will reach the end of that 10-year period. So what I would say to you is think about what your money's for. Who's it for? What you're going to do with it? When are you going to use it? How much are you going to need? How is tax going to impact you? And it might not be Australia. You might be sitting here thinking, well, I want to know about Australian property because I have it, but I'm actually going to retire somewhere completely different or work somewhere different. We can also help you with that aspect of tax. What about your family? How do you want them to participate during your life, after your life? Make sure you're on track. Come and speak to Tall Rock Capital because we can help you. The initial discussions with Tall Rock Capital are free of obligation, and we don't give you a bill for the initial conversations. Make sure you've got the right plans in place, because if you don't, you could find yourself having a nasty shock when it comes to trying to use your money. That's it from me. I know I'm going to hand back in a minute to Alvin, who will do the Q&A. I've also got an important information slide, but I won't leave it there for very long because I think we want to be able to get back. Now, how do I? There we go. Right, so I think, are we going back to Alvin for Q&A?
Yes, Ian. Thanks, Ian, and thanks, Stephen and Paul, for the insightful sharing. So I already see a lot of questions popping up in the chat and Q&A. Just to give you guys a heads up, if there are more questions, please input them in the Q&A section, together with which speaker it's directed to, and we'll do our best to take all the questions in the limited time that we have. So I'm going to start with the first one. I believe this is directed to Paul. So Paul, the question is, okay, I understand that Singapore and Australia have a tax agreement, but as an Australian resident, do I still have to pay tax on the income I earn in Singapore? Paul, you're muted.
Sorry. Yeah. First thing just want to clarify. Assume when you say Australian resident, you're talking about being an Australian tax resident, but you're earning income from Singapore. In that way, yes, tax is still liable on Singapore income, even though we have a DTA, because the DTA is only to protect you, and most income is that for whatever tax you pay in Singapore, you can apply it as a foreign credit in Australia. But you're looking at the difference in terms of tax rate between maybe 22% to 47% in Australia. So you still need to make up the difference if you are a tax resident in Australia. If you're a tax non-resident, obviously whatever you make in Singapore is not taxable in Australia.
All right, thanks, Paul. We have another question, and I believe this is directed to Ian. So the question is, can you transfer existing US stock into the offshore life plan?
Absolutely, yes, you can.
All right, thanks,
Ian. That's a very short answer, but yes.
Yeah. You might want to elaborate a bit more, be good.
Yes, I mean, basically, it's a fairly straightforward process. We establish the offshore life plan structure, and you re-register the stock from whichever platform it's on into the life platform, into the life plan. It's something we do very regularly, not just for Australians, because this impacts UK nationals and others as well. But it is a very straightforward process to do. If these are shares that you have acquired through share options, do bear in mind it is only vested share options that you can transfer into the plan. So, for example, I have a friend and a client. He has transferred his shares from a large US IT company into his offshore life plan, and every 3 months he gets another vesting event, and we transfer that batch in to join the others. So sometimes it will be a start and then on a regular basis if it's RSUs or share options that are vesting over a period of time. But if it's shares or funds that you hold now, yes, absolutely, these can be transferred. You don't need to come out of the market if that's the question.
All right, thanks, Ian. And the last, we've got 2 questions. I think I'm going to combine them, and this is directed to Paul, I believe. So it says, will this property income attract Medicare levy? And why do we have to pay Medicare when we cannot use it as an expat in Singapore?
Yeah, to be more precisely, if you're non-resident for tax purpose, you do not pay the medical levy because we get exemptions as a non-resident. Yes, you're true. You're right in the way that we don't get the benefit of living overseas, and on that basis, you can get exemptions on the medical levy surcharge. So if you're having rental income in Australia, you just pay the normal 30% tax. You don't need to pay the 2% medical levy as a non-resident for tax purpose.
All right, thanks, Paul. I think we have time for the last question. So this is to Ian. Does the offshore life plan still have tax benefits if you take distributions not as an Australian tax resident?
Yes, it absolutely does. I mean, if you're living in Singapore, and I guess to a large degree, if you're living in Hong Kong, we're lulled into a sense of false security because we're not taxed on dividends, we're not taxed on gains, we're not taxed on interest, and we think life is lovely. But in most countries around the world, you would be taxed on these. So take, for example, you're not in Australia, but you have a posting in London, then it is possible to take money out from that plan while you're in London to supplement your lifestyle without it becoming assessable income in the UK. So yes, there are decidedly tax benefits around the world. The problem is there are 195 countries, and we've got about a minute left. So.
Okay, go ahead, Ian.
Sorry, I was just saying that yes, there are tax benefits in countries around the world. It's not just Australia, but to go into every country and how it works, we don't have time to do that tonight.
Okay.
We would be delighted to sit down with anyone and discuss with them jurisdictions that they are thinking of and how it would work and what the mechanics would be for those jurisdictions.
All right, thanks, Ian. And thanks for bringing that up. So for everyone who is part of the webinar right now, if you have more questions, what's going to happen after this is all of you will be receiving an email with links to be able to book meetings with our tax team, with our mortgage team, as well as the team from Telrock. So I think they'll be able to help you dive deeper into more of the questions or queries that you might have. And with that, we've come to the end of our webinar. Again, I'd like to thank everyone for joining. I'd like to thank Ian from Telrock and Stephen and Pao from Odin for the time that you took to share all this insightful stuff with everyone here. And we hope to see you guys in the next one really soon. We'll be sending out the dates for that as well. And have a good one, guys, and enjoy your weekend.
All right,
Thanks,
see you guys.
Thanks,
Thanks,
Yeah.
everyone.
everyone.
Thank you. Bye.